Guys, right now we are seeing something on the XRP ledger that almost never happens. I don't mean retail noise, hype, or short-term joy. There is a level of organized, highly structured, institutional level activity going on that has researchers, on-chain trackers, and even people who have been familiar with XRP for a long time saying, wait a minute, this is different. It looks less like retail speculation and more like infrastructure deployment. This is the kind of work that you'd see when a big financial platform quietly gets ready to start a new product. And if this is true, it could have a much bigger effect on the price, demand, and use of XRP than people think. Hey, nice to see you again. I hope this day is going well for you. All of that is normal growth. However, the growth we're seeing now isn't normal. A lot of accounts are being made at once. In just a few days, almost 40,000 new XRP accounts will be made with a unique wallet that is set up on the blockchain. It would be a very different trend if this were just a flood of new retail users. There are waves of shopping. It spikes for no reason. It's a mess. It's not organized, well-planned. Plus, it gets clearer as you look at it more. This is the institutional design that is being used on the XRP ledger. And this is where Jungle Inc.'s remark is very important. The accounts in this group follow the exact pattern of building out infrastructure. Separated accounts, sub-accounts, automated scripts for making wallets, custodial structures, and sets that are in line with regulations. This is what happens when a business wants every user, client, and customer to have their own cash. It is not a shared bank, not a structure that is shared, a real account in a person's ledger. And in the world of crypto, only a few things work at that level. There are trading systems, exchanges, brokerages, and big fintech companies. The next question that comes to mind is, who is doing this? Who is building the infrastructure for the XRP system on such a huge scale? The most likely explanation is Robinhood, which fits almost too well. The pieces fit together amazingly well when you follow the clues. Robinhood bought Bitstamp a few months ago. It is one of the oldest global platforms. It wasn't just any exchange either. Ripple and Bitstamp are joined at the hip. There was even a plan to build a crypto derivatives market with Ripple, which was well underway before they were bought. Next, Robinhood buys Bitstamp, and all of a sudden, there is silence. Up until now. At the same time that Robinhood is getting ready to release their own line of derivative goods. You have to think about where Robinhood would put something new, fast, and made for high-volume payment if they wanted to bring it to market. Bitcoin, not fast enough. Ethereum, too many fees. Solana, not enough of an institution. But XRP Ledger, very fast, very cheap, built for institutional systems already and fully linked with Ripple. It fits almost too well because it doesn't matter if this is Robinhood, Bitstamp's derivatives market, or some other big institutional player, it's still important. This is what it looks like for mass acceptance to happen. Millions of regular users aren't all of a sudden learning how to make self-custody wallets and secret keys. That was never going to happen. That was never the right way to go. Enterprise integration has always been Ripple's main goal and the real way to go. Tens of thousands of wallets are made by one big group. Then, those wallets become the main way that millions of people use blockchain technology, and they might not even know it. They don't need to know. They don't need to learn. The service users only need to use it, and the XRP ledger will take care of the movement, payment, speed, efficiency, and interoperability in the background. Just think about how every day people use the web. They don't deal with data packets, IP numbers, or DNS routing tables. They are just starting up apps. They're clicking on things. They get help from technology that they can't see. The same trend will show up in the use of blockchain, and this seems to be the start of that change. And if this is Robinhood, this has huge consequences. Robinhood is a site that a lot of individual traders use, and their business for big investors is growing quickly. When you combine that with Bitstamp's infrastructure and Ripple's work on derivatives, you have a situation where XRP Ledger infrastructure is being used for user accounts, settlement of derivatives, and high-frequency trade. That's not little. There is no comment there. That's not just a joke attempt. With XRP ETFs now available, that's the kind of combination that Wall Street really pays attention to. Robinhood wants to be the first platform to offer derivatives built on top of the XRP ledger. This means that XRP is no longer just another cryptocurrency asset. It is now the technology that makes products possible that institutions understand and use. That's what makes them different. Meme coins don't matter to Wall Street. They are not interested in guessing just for the sake of guessing. They want something that is useful, has a lot of output, is reliable, and can be scaled up. The XRP ledger has all of the required information. That brings us to another thing going on right now, how XRP prices work. The reason for this is that consumer confidence is at its lowest level in years, while all of these establishment plans are being made. This is old school. This is what takes place before big moves. People get antsy, they get worn out, they believe that nothing is going on. They believe that XRP was forgotten by the market. They don't see the picture anymore. It's amazing how much the structures from 2025 and 2017 look alike. It's not because things always go the same way, but because of how people feel. A lot of people said the same things in 2017, right before the biggest XRP rise ever. XRP is no longer useful. It's not going anywhere. It's not fun. It won't move, before it went on to have one of the fastest and biggest rises in crypto history. And the truth is that the biggest moves in XRP's history have always started during these dull, quiet, sideways periods. In the past, XRP has made its biggest gains when most people are asleep, when no one is paying attention, and when the news turns bad. All of the items are back on the table now. Institutional activity, the growth of ETFs, the infrastructure for derivatives, the rollout of wallets, and the mood profile all look a lot like they did right before XRP shocked everyone. And something is even more clear when you look at the current on-chain trends. It's not random or shallow for so many accounts to be being made at once. These accounts are being set up with the kind of institution-level consistency that you only see when big systems are getting ready for new flow by setting up onboarding pipelines, custodial structures, and user-level segregation. These aren't wallets for hobbyists. There are no spam bots in these wallets. These aren't just random groups. These deployments are planned, designed, and patterned to fit the needs of a company getting ready to move or set up tens of thousands of new user endpoints on a settlement layer. That's the important thing. There is no speculation in this building. It looks like a village. To avoid making thousands of chain-level addresses, most systems that deal with customers would rather use shared accounts, omnibus wallets, or internal credit ledgers. It's simpler, cheaper, and easy to move around. But the XRPL is one of the few blockchains where making thousands of accounts is not only cheap, but also good for tracking, control, and compliance. With sub-account structures, a business can directly connect users to names at the ledger level while hiding the user experience. The person who used it doesn't even know what changed. Behind the scenes, the company only moves the lines. There is something very important going on here. This person is getting ready for a system where each user has a unique name that is based on the ledger. And you want that if you're making a derivatives platform, a brokerage infrastructure, a custodial network, or some other type of multi-user institutional offering that needs accounts to be able to move quickly and safely. In that setting, the XRPL works very well. The speed is almost instant, the fees are very small, the trustworthiness is very high, and the ledger is set up so that you can do a huge number of transactions without slowing down the chain. Now, think about what that means if a company the size of Robinhood or any other company on that scale is building a network of wallets that are directly linked to their users. Every wallet is a possible destination for a customer. Each ending is a possible use case for a new product line. If these wallets are being made ahead of time, the system may be getting ready for a cold launch in which everything goes live at once and the rails are already set up and ready to go. This is exactly how institutions set up infrastructure ahead of time, out of sight of the public, and in secret. Everything is built and tested before the reveal. The rate at which new accounts are made is another thing that stands out. Instead of being spread out randomly, these wallets are showing up in groups, often automatically and often together. That means the organization using them probably has a script or an internal tool that makes a lot of account layouts. Exchanges and brokerages use this exact method to automatically add new customers behind the scenes. And it's even more interesting to think about how Bitstamp was already deeply connected to Ripple through technical integrations, liquidity corridors, and cross-border settlement methods before it was bought. It's very important that Bitstamp and Ripple were working together on a special infrastructure, since derivatives need to be fast, accurate, and cost-effective on a large scale. These are the places where the XRPL completely beats all other options. If Robinhood got that infrastructure, it would make sense for them to keep working on it, especially since they've talked about growing their foreign and institutional services. Robinhood no longer wants to be just an exchange. They want to become a world hub for money, and global systems need rails that regular blockchains can't give them. Now let's talk about what could be even bigger effects. Since the pattern points to a big new trend in the crypto world, it doesn't matter if this is Robinhood or not. Institutions are getting ready for financial goods that are tokenized and built on the blockchain, but not on the chains that most people think they are. A lot of blockchains today are made in ways that make them great for speculative ecosystems, games, NFTs, and decentralized finance, but not for the boring, high-volume, compliance-driven work that banks need to do. It was made to be more like a backbone, a settlement fabric, or a base layer for moving money in the real world. And we're finally starting to see that design purpose show up in how things are used in the real world. Think about what happens when a company wants to tokenize positions, move collateral right away, or settle derivative contracts without having to wait several minutes for approval. You don't want that to happen on random layer 2 chains or blockchains that are hard to predict and have fees that change all the time. You need to be stable. Predictability is what you want. You want a deal that is final in seconds, not minutes or hours, and you want a record that is open enough for both sides to check, public enough to be checked, permissionless enough to grow, and structured enough to stay organized. This is where XRP Ledger comes in handy. And if this really is the start of a move toward ledger-based settlement for big platforms, then this kind of mass account rollout is the perfect place to start. You start by setting up user shells and ledger endpoints. This way, when you add deals, flows, or product lines to the chain, each endpoint is already ready. Users don't need to do anything. They'll have no idea what changed, and that's how crypto will really be used. For users, it's invisible, but it changes the system. Imagine that millions of Robinhood traders or tens of thousands of business accounts have XRP Ledger wallets hidden away. They wouldn't even know it. That would greatly increase activity and liquidity on the chain by itself, even if users never touch their wallets directly. It would also make a huge difference in the amount of transactions that go through the XRPL, since all flows, settlements, and movement would happen at the ledger level. Once the machinery is in place, the next step that makes sense is to roll out the product. That could mean derivatives, tokenized assets, or fast settlement for brokerage flows, among other things. The style stays the same though. First build, then softly deploy, and finally flip the switch. It's also important to note how this fits into the larger story shift that's happening in global banking. Crypto isn't going away, and more people are realizing it, not because people are guessing, but because these methods are better for technology in other ways. People love the word internet, but that didn't help the internet grow. The same will not happen with blockchain, because people love crypto tokens. Companies want faster settlement, lower prices, systems that can be put together in different ways, and real-time mobility of value. It doesn't matter what people think. An XRP system is one of the only blockchains ever designed to solve the problems that banks actually have. The market as a whole is still stuck in cycles, trends, and stories. At the same time, the XRPL is slowly bringing in the right kind of people. These are the companies that move a lot of money and have a lot of customers. They need solid rails at scale. And while people in retail get bored, sidetracked, impatient, or doubtful, institutions move quietly. Behind the scenes, they build. They go ahead and launch first, then explain. And by the time the news gets out, the infrastructure has been up and going for months. This spurt of new accounts is so important because of this. It means that a new phase is about to start, one where big companies start to use XRPL rails for real business purposes, not just for gambling. This is not advice about money. Another important thing to keep an eye on is how these institutional marks on the XRP ledger match up with a certain type of infrastructure shift that usually happens before big financial changes. A business doesn't start by moving money when they are getting ready to move users or financial operations to a new payment system. The first thing they do is get the building ready. Not seen by the public, not seen by customers, not seen by retail markets. This really does look like that. Large organizations, especially those that are regulated or do business in more than one area, follow very similar rollout stages. The first step is the silent build process. This is when technical teams run internal tests, set up account structures, and make sure that data paths are all lined up. The second step is ledger provisioning. This is when systems set up tens of thousands of endpoint accounts in preparation for future action. Third, there is the internal migration phase. This is when small amounts of money, fake transactions, or internal test flows start to move through the tracks. In the fourth step, called liquidity, market makers, partners, and counterparties start to put money along the routes. The last step is the public release phase, when the product, app integration, or settlement route that customers see goes live. There are clear signs of Phase 2 in the XRPL right now. When Phase 2 shows up at this scale, something bigger is generally close behind it. What a difference the little things make. These accounts aren't just being made up for fun. They are organized, they are split up, they're clean, they follow the same architecture. This means technology in the back end. It means that the equipment is ready. It means that you are in line with compliance rules. And it means working together. Now, if the rumors are true, and Robinhood is the one setting up these XRPL destinations, this is a lot more than just good news. It's the start of a real institutional migration, and one of the first large-scale uses of XRPL-based rails by a big US-based financial brand with a presence around the world. But the effects will still be huge, even if it's not Robinhood. It could be any other prime broker, liquidity venue, payment platform, or digital asset infrastructure provider. In institutions, work is going toward ledger-native architectures because the pattern is the same. The XRPL is perfect for this type of deployment. One thing that people don't understand about the XRPL is that it was made from the start to be easy for machines to use. That means fees that are easy to plan for, quick settlement, steady performance, and little change. Many blockchains say they have high throughput, but they break when institutions keep using them or when there are fast changes in funding. The XRPL is one of the few chains that can work in these conditions without having to change its economic structure or technical base. It has a strategic edge that institutions care about because of this. They can work it into their plans. They know how much it will cost them. They can guess when confirmations will happen. They know what will happen when there is a lot of traffic. They can add more users without having to write a new system every 6 months. This is also why making this many accounts means something important. Since schools don't plan for 40,000 users unless they think that demand, throughput, or user number will require that structure, and if the starting point is 40,000, the end result could be much higher. Regulatory standing is another point to think about. The timing of this infrastructure growth couldn't be better, as XRPFS is about to go live and global regulatory frameworks are coming together. Groups of people don't want to fall behind. As soon as ETFs make it easier for regular people to understand and follow the rules about XRP, utility-based systems will be the next step. ETFs bring in money. Using ledger technology is useful. And when those two come together, liquidity, network activity, and real-world usage all grow at an exponential rate. In the early stages of a liquidity shift, things look like this. The first thing you do is build the tracks. Then you set up the ending points. After that comes the money. When the crypto market is quiet, it often thinks that things are staying the same. In institutions, on the other hand, quiet times generally mean getting ready. Big changes rarely start with news stories. They start with building. As this design comes together, it naturally brings up the bigger question that everyone who is keeping an eye on the XRP ledger wants to know: what does this kind of infrastructure setup mean for price? The price is the last thing that changes. Utility is what it all starts with. Buildings and roads are the bridge. Flow of money is the fuel. But price increase usually happens when all three layers come together. In 2017, XRP moved very quickly, but it wasn't just because of retail hype. It moved quickly because of underlying energy and the hope that it would be useful. But now the system is stronger. The connections between people are stronger now. The schools and colleges are bigger. The pipes are fully developed. What about the financial world? It's very different now, and tokenized settlement is becoming less of a choice and more of a must. There is sustained volume, sustained liquidity, and sustained awareness when institutions accept a chain on a large scale. These are factors that can drive price much more aggressively than short-term speculation. The important thing is that these moves don't happen when everyone is excited. They take place at night, when everyone is asleep. And the mood among regular people about XRP is surprisingly quiet right now. In the past, that's when XRP has done its most wild and surprising things, but the time is even more interesting. As we move into next year, the bigger picture of the world is perfectly set up to make alternate settlement networks appealing. The rates are changing, Regulatory systems are becoming more stable. Real-world goods are becoming more and more tokenized. Also, banking companies are under a lot of pressure to work more efficiently. All of a sudden, blockchain settlement can solve issues that regular tracks can't. The XRPL is one of the few chains that can provide those answers right away without needing any new tools, major redesigns, or strange engineering. If a bank needs a quick, cheap, and reliable settlement option, the XRPL is ready to use. It is possible for the XRPL to make thousands of separate user accounts at the same time. If they want flows that can be tracked for compliance, the XRPL is open enough to meet control requirements and decentralized enough to stay adaptable. The XRPL has already shown that it can give them high throughput, low cost, and low delay. We can see this institutional compatibility more and more with each on-chain impact we see. And trade volume goes up as settlement rails move on-chain. The number of transactions goes up as the number of user accounts goes up. As more liquidity players join, the depth grows. And network effects get bigger as groups link up. That's the real way adoption works. Not with marketing or hype cycles, but with infrastructure that slowly comes together behind the scenes until it's the norm all of a sudden. Right now, you are seeing the beginning stages of that shift. Over time, as this infrastructure keeps growing, these accounts keep showing up, and these institutions keep setting up shop, retail will look back and wonder how they missed the signs that were right in front of them. When people aren't looking, price moves. It doesn't move when people are looking.